Hey, good morning, everyone. Marty Mazzori here. It's Friday, the 23rd of January, 2026, with a pretty quick update for you. I'm going to focus mainly on the charts. They will inspire my dialogue about world affairs that I think are impacting markets at the moment. But since the last one I dialed up is one that's already on your screen, I think I'll start there. And what you see there is the consumer sentiment indexes, or the results of the surveys, the two that we track, the conference boards on top and the University of Michigan's on the bottom. And the University of Michigan's just came out, and I'm just pulling over that for you here. So 56.4, which was better than the consensus estimate. The range was 54.5 at the high end, 54 prior, so that looks like consumer sentiment is improving. The chart is for me to help you put it in perspective. What's interesting is still pretty high year ahead inflation expectations, and make no mistake, folks, it is the inflation and job prospects and so forth. A lot of fear out there among consumers. You wouldn't know it necessarily by action in the stock market, and I can talk about that as well, and we'll continue to. But I want to just to point that out here. This is that survey. You can see that even though it's improved, it is historically very, very low. Hasn't been this low outside of the bear market in 2022. Otherwise, these are recession level sentiment levels, if you will. And then the conference board, you can see the trend not going in the right place. And I suspect that this speaks to that, K-shaped economy that a lot of people, including us, are talking about. And that is that you have that upper move in the letter, right? The line that points up really represents folks who have good incomes and own assets. The lower level, or the lower half of the K, is the folks who don't, right, and who are late on their credit card payments and auto payments and so forth. I suspect that they are largely, impacting the results of these surveys right here. And I saw that evidence this week when I was looking through earnings reports for airlines. They are seeing nice growth in the premium class seats, not so much in the coach seats. So again, just more evidence that folks who have money are enjoying it and spending it, and it's making a real impact on the economy. And those who don't, doing the best they can, but they're suffering a bit. If we're right about the new populist regime, which is obvious, right, that's the world we live in now, folks will receive more support from government as time goes on, as things deteriorate, if they do indeed, in the economy. I've talked already about the impact on the economy of the One Big Beautiful Bill Act that's coming. It's a very supply side endeavor, meaning definitely is, business oriented with big depreciation deductions and not as much consumer oriented. However, one of the impacts of it will be the massive, from what I understand, tax refunds that are coming, because as rates were adjusted lower, last year's withholdings weren't adjusted. So I keep hearing that it's going to be record tax refunds in 2026. That could improve sentiment notably. Now, whether or not these surveys improve that much, we're probably going to see a nice pop in consumer spending in the spring when those checks start coming in. Speaking of consumer spending, we got the most recent numbers there yesterday. Now, this is still somewhat delayed. This is for November. You can see that personal income expectation was 0.5% increase on the month. We ended up with a 0.3% increase. But consumption expenditures, people spending, was expected to go up 0.4%, but it went up 0.5%, 0.5%, like it did the previous month. The price index, so inflation, 0.2%. 0.2% was the expectation. Year over year, 2.7% actually went up by 3%. Core, which X's out food and energy because they're so volatile, was up 2% month on month and up higher than expected, 3.0% versus 2.8%, which was the estimates. Okay, so let's get to the market. So the S&P 500 as you can see, is still right on that spot where it was back at the end of October. So as you can see, we continue to kind of consolidate right here within this range. Our momentum indicators, as I like to point out, continue to flash these bearish divergences, which would suggest that ultimately there's probably some pain coming for the market. That's a sell signal right there. I mentioned the 50-day moving average. If we broke down below that, that would be problematic. And sure enough, we'll talk about this gap right here. We closed below it, but then the next day, as the bulls needed, it closed above it. And you can see we're just flirting right here with this all-time high area right up in here. But again, some momentum says that if you had to place a bet here, you'd place the bet on a correction. But there's no sell signal just yet. If we got a good solid break that lasted a day or three below the 50-day moving average, that would be a technical sell signal. And you can see it's flattening out here. As well. We kind of saw this coming. I think I talked about it over the weekend. I could tell in the synthetic markets or dark pools or whatever you want to call them that the market did not like the news that we were going to throw tariffs on the European countries that were pushing back against the Greenland ambitions of the U.S. And, you know, the U.S. was threatening military action. So the Dow had about a 900-point down day that day. Gold rallied hard, precious metals rallied hard. Our core did fine. It was basically flat, just a little bit down on the day because of these real asset positions that we hold. And then the president, before the open on Wednesday, said no military action. And then later in the day said, we're not going to do the tariffs either. We're coming to an agreement. And the market really liked that. And he even commented on the stock market. He said, that's a blip. He said, stocks are going to double. So just like the first term, and we talked about that a lot, this particular president seems to be very fixated on the U.S. stock market. And it does seem to have sway in some of the decisions that are made, I think. So that's how the technicals look, somewhat ambiguous here. I'm not bearish, to be honest with you, with all this fiscal stimulus coming. So, but the technicals tell us that we should be cautious. The NASDAQ 100 index, remember I pointed out this symmetrical triangle, and I said that you tend to get somewhat violent breaks from that, and we did have that violent break. That was over 2% drop on Tuesday, right after the weekend news that I just talked about. And then with the Wednesday news and the big switch in commentary from the top, then the market, came bounding back. NASDAQ still, though, is doing what the S&P is doing, momentum. While we're kind of holding up at these levels, the underlying momentum is fading. And that's not a great sign and doesn't invoke great confidence in the sustainability of these levels, but we've seen this before. And as I keep saying, one more time, there's some pretty significant fiscal oomph to hit the market. The concern is, though, that as that hits the market, if indeed we don't have other headwinds, perhaps the geopolitical headwinds, then consumers are right to be concerned about inflation and look out for higher yields that, equities will have to contend with. The dollar, as I mentioned, you would have expected maybe, I said that over the weekend, that the dollar would rally on that uncertainty. Dollar's not doing that, right? The dollar's not looking of late like the big defensive currency that, it once was. I'm not doubting the dollar's position there, and I do think that when we get something that's very panicky, you will see the dollar spike higher on that, and treasuries rise and yields go down. But right now, the net pressure, we hit this level. I mentioned that 100 technical level, and sure enough, we came right off of that and are now testing this 98 level right in here. So events will determine what the dollar does here in the short run. We are long-term bears on the U.S. dollar, by the way. Gold continues to just defy the charts. In fact, if it keeps up, it's going to burn through this very bearish divergence right here. Very overbought on the daily. I've shown you the monthly chart on gold. We've never been at levels like this. Haven't been here since the 70s, and we've never been here without something significant in terms of correction to the downside. Gold reacted on Wednesday. I think silver was down like 4% or something for a moment. But now we're talking about Iran again, and I think ships are heading in that direction. So no reason to let go of your gold right here from a geopolitical risk standpoint. Plus, from the headlines that I'm seeing, the retail investor seems to have caught on to the frenzy and has a bit of FOMO right here. So I saw a headline that said, retail investors are abandoning U.S. tech stocks in favor of gold and silver. Now, retail investors, if they're really underinvested, could keep this going for a while. But typically, the old adage is true, and because I've lived it for 41 years, that the retail investor is usually the last one in and the last one out. So when you start hearing that the retail investors are getting really excited about something, typically, historically, that's when you start getting a bit concerned. What does Warren Buffett say? He gets fearful when everyone else gets greedy. And by the way, he gets greedy when everyone else gets fearful. And then add in, and a friend reminded me this morning that JP Morgan just put a $5,400 price target on gold for the end of the year. And my reply was, yeah, that's certainly possible. I'll be surprised if it goes there in a straight line. I do think in the near term, little geopolitical certainty, little rates beginning to rise when the stimulus comes in, and you could see some pretty aggressive profit taking in a metal that we are long-term very, very bullish in. But we did roll our hedge closer to the money, expecting that something to the downside is in the offing. Or let's put it this way, whether it happens or not, I would be happy to debate with anybody that the risk of something noticeable to the downside is elevated here, to put it mildly. Same thing for silver, just continues to kind of go to the moon, right? This is a chart, this is a level that's not sustainable, certainly a pace that's not sustainable, overbought. So we'll see. The 10-year yield actually spiked up. People didn't buy the Treasury on the scary Greenland news. They actually sold it, which forced yields higher, and then they've been buying it here the last few days on balance. So we very quickly filled the gap that we had right here. Remember, 90% of gaps get filled. So when we see a big gap higher, the vast majority of the time, right, we see those gaps get filled. So there's a nice one there on gold that would get filled with a pretty good drop from these levels. We'll see if that plays out that way like it always has. So folks, yeah, we've got, with the precious metals, we have the Greenland situation that it looks like that's going to go away. That was never going to happen, by the way. The Iran situation could happen. Gold does deserve a premium when we have that kind of geopolitical risk out there. Of course, the near-term problem with striking Iran is it is counter to the president's ambition of getting the price of oil down, which, by the way, is up nearly 3% right now on that news on the day at $61 a barrel, 66 for Brent crude. So anyway, folks, I'll stop rambling there. I think that's all that needs to be said for now. When I do the weekend scoring of our various indicators, I'll get back to you if I think there's something that you need to know. Hope you have a wonderful weekend. Talk to you next week. Take care. Bye-bye.